As you've noticed throughout this course, I believe that in-depth reviews of financial documents tell unique stories about our lives, discovering countless opportunities for deeper quantitative and qualitative conversations. But most of us are never taught how to review these relevant documents, including one of my favorites, the Federal Income Tax Return, Form 1040 with its supporting schedules. Combining knowledge from the Certified Financial Planner and the IRS's Enrolled Agent Education programs, I've enjoyed connecting the dots between taxes and all the other planning topic areas. Since every movement of money involves a tax consequence or a specific exclusion, I think it's impossible to provide comprehensive financial advice without intentional tax planning. So I encourage you to download your most recent tax return as we walk through it together step by step. I hope you learn a lot and discover unique opportunities for your own situation. Starting at the top of Form 1040, which is the federal tax return, you'll find your name, social security number, home address, and tax filing status. Although this status appears as a simple election, it will affect deductions, credits, and tax rates along the way. Single and married filing jointly are pretty straightforward, based on your marital status at the end of the year, except that a surviving spouse may claim married filing jointly in the year their spouse dies. Suppose the surviving spouse does not remarry and cares for a dependent child moving forward. In that case, they may be able to file as qualifying surviving spouse, but only for 2 years following their spouse's death. And in the following years, then they'll switch to filing as single or head of household if they continue caring for tax dependents. Lastly, married couples can choose married filing separately if they want to be responsible for their respective taxes, or if filing this way results in less tax or other payments owed. Married filing separately is commonly selected when one spouse wants to qualify for lower income-based student loan repayment, keeping in mind that they may lose out on some tax credits and deduction opportunities, including education tax credits and the student loan interest deduction. Next is the digital assets section. This box does not indicate whether you own cryptocurrencies or not, but rather if you are involved in digital asset transactions. The standard deduction section includes checkboxes to report whether you are eligible for additional standard deductions, age 65 plus or blind as of the last day of the year. And next, you will fill out the dependents section if you provide more than half of the support for a qualifying child or relative, and if they're eligible for the child tax credit or credit for other dependents based on whether they are younger than age 17. And now we can move on to the numbers. The income section starts with all taxable wages received as an employee on line 1A. This amount comes from your combined Forms W-2 in Box 1, Wages, Tips, and Other Compensation. Keep in mind that your pre-tax workplace retirement plan contributions, workplace HSA contributions, and pre-tax group benefits premiums have already been excluded from Box 1 and cannot be deducted again on your tax return. No double dipping. We'll see more examples of this moving forward. Moving back to Form 1040, lines 1B through Z include rarer forms of income. Lines 2A and 2B report non-taxable municipal interest and taxable interest income received within your taxable brokerage and bank accounts. If you receive municipal bond interest and also file a state income tax return, the bond interest received from municipalities within your state may be misreported as taxable interest if you or your tax preparer aren't meticulous. If your taxable interest amount on 2B exceeds $1,000, this may indicate a significant cash, money market, CD, or other fixed income position within your non-retirement accounts, such as your emergency fund. Nothing to worry about as long as you're being intentional. Additional information regarding your interest income is included on Schedule B, Part 1, a handful of pages below the Form 1040. Lines 3A and 3B report qualified dividends and ordinary dividends received within taxable brokerage accounts. Commonly misunderstood, your ordinary dividends include your combined qualified and non-qualified dividends. As we learned during the taxable brokerage account lesson, qualified dividends are taxed at a lower capital gains tax rate, 0%, 15%, or 20%. In contrast, non-qualified dividends are taxed at the ordinary income tax rates, 10%, 12%, 22, 24, and so on. I divide the qualified dividends into the ordinary dividends to determine the percentage receiving favorable taxation. In this example, $35,101 of the total $43,442 equals 81%, meaning most dividend distributions received within the taxable brokerage accounts have received favorable tax treatment. If the percentage of qualified versus ordinary dividends is much lower, you likely receive non-qualified dividends and interest distributions from bond funds or real estate investment trusts, also called REITs. If you'd like to understand the sources of your dividends, look up Form 1099 DIV that your account provider sent you. 1B shows the qualified dividends, and Box 5 includes those REIT dividends. Continuing with Form 1040, lines 4A and 4B show IRA distributions and Roth conversions from Form 1099-R. These include traditional IRAs, Roth IRAs, SEP IRAs, and simple IRAs. If the taxable amount is shown and is lower than the total distribution amount, as we see here, this indicates a non-taxable IRA rollover or a pro rata distribution of IRA cost basis versus earnings, which we'll investigate further. If the IRA distribution included a rollover, the word rollover would be shown next to line 4B. As mentioned during the tax-optimized charitable giving lesson, IRA owners over age 70.5 can make non-taxable qualified charitable distributions, QCDs. That would also be noted here, commonly missed by tax preparers who don't ask clarifying questions. Here is the Form 8606, which reports non-deductible traditional IRA contributions and year-end IRA cost basis in Part 1, IRA Roth conversions, including backdoor conversions in Part 2, and Roth IRA distributions in Part 3. If you implemented one of these strategies, ensure this form is included in your federal tax return, one for each applicable spouse. Otherwise, you may pay taxes twice on the same money accidentally. Since this example taxpayer converted portions of their traditional IRA to a Roth IRA, but still had pre-tax balances in their IRAs by the end of the year, a portion of the conversion was included in taxable income. To avoid this taxable conversion, they may have had the opportunity to transfer the pre-tax IRA balances into their workplace retirement plan, then convert the remaining after-tax balance without any tax consequences, aka a backdoor Roth IRA conversion, as we reviewed previously during the Roth IRA lesson. Back once again to Form 1040, pension and annuity payments are reported on lines 5A, 5B, which may include distributions from 401ks, 403bs, and 457b plans. An exclusion ratio of pre-tax versus after-tax payments applies if the taxable amount is lower than the total amount shown. Rollovers from qualified workplace retirement plans will also be displayed here, with the word rollover entered next to 5B. Lines 6A and 6B report Social Security income benefits. Only up to 85% of Social Security is included as the taxable amount, based on what's called combined or provisional income. More information about the combined income formula and the 0%, 50%, and 85% inclusion of Social Security benefits is linked below. Line 7 reports net realized capital gain or loss. A handful of pages down the return, Schedule D may list short-term and long-term capital gains and losses and how they're netted against each other in more detail. As mentioned during the taxable brokerage account lesson, up to $3,000 of net capital loss is available to offset ordinary income, with the remaining carried forward to offset future capital gains. Form 8949, also part of your tax return, includes the detailed trading activity, including what you bought and sold and for what amounts. Moving on, line 8 is additional income, which flows from Part 1 of Schedule 1. The most common forms of additional income on Schedule 1, Part 1 come from self-employment, flowing from Schedule C, and rental real estate from Schedule E. Here is Schedule C, which reports gross income, total expenses, and net profit or loss for self-employed businesses. And this is Schedule E, which reports income or loss from rental real estate, partnerships and S corporations, and estates and trust. At this point, you may realize that the federal tax return has multiple levels. This form ends with a number that flows to this form, that ends with a number that flows to this form. At first, it's a bit overwhelming when you're trying to determine which level you're on. It reminds me of that movie Inception, where you're trying to figure out if you're in a dream or a dream of a dream. So for now, let's come back to reality, the Form 1040. At this point, all forms of income we've covered are combined and entered on line 9 as total income. Then, line 10 reports adjustments to income that flow from Schedule 1, Part 2. These are often called above-the-line deductions, since they appear directly above the adjusted gross income line on the tax return. On Schedule 1, Part 2, these deductions often include HSA contributions that are made outside of payroll, the deductible half of self-employment tax, self-employed retirement plan contributions, self-employed health insurance premiums, deductible traditional IRA contributions, and student loan interest. As I mentioned previously during the HSA lesson, Form 8889 reports those health savings account contributions and distributions, including whether they paid for qualified medical expenses tax-free. After those adjustments to income, reduced total income, we naturally arrive at adjusted gross income, AGI for short. This number is worth noting since it's the starting point for numerous benefits, deductions, and credits, including the premium tax credit for health insurance premiums and Medicare surcharges, also called IRMA. Although income was already potentially reduced above AGI, it's actually reduced again on line 12, either receiving the standard deduction or itemized deductions, depending on your tax filing status. These are called below-the-line deductions. Schedule A lists itemized deductions that may combine to exceed the standard deduction. Common itemized deductions include medical expenses above the 7.5% AGI floor, state and local taxes capped at $10,000 per household, including property taxes, deductible mortgage interest, and gifts to charity. If you give to qualified charitable organizations and aren't able to itemize your deductions, be sure to watch the Tax Optimized Charitable Giving lesson for alternate tax savings opportunities. Back to Form 1040 once more. Line 13 reports the QBI deduction to provide relief to small business owners and pass-through entities, which may reduce qualified business income by up to 20%, including qualified REIT dividends received within taxable brokerage accounts. All right, we finally arrive at taxable income, which is the variable required to calculate ordinary income tax and capital gains tax. I am sharing these federal income tax rate charts to help you estimate ordinary income tax liabilities based on taxable income. The marginal tax rates based on taxable income are listed here, including the basic calculations for estimating your taxes owed. Keep in mind this chart does not consider capital gains taxes, tax credits, or additional taxes. All right, we've completed the first page of the Form 1040, ending the income section. Now let's move on to the second page to review taxes and credits, payments, and amounts owed or refunded. Tentative tax is calculated on line 16 by applying the marginal tax rates to ordinary income and the capital gains tax rates to qualified dividends and long-term capital gains. And then various non-refundable tax credits are subtracted and additional taxes are added, which commonly include child tax credits and credits for other dependents, non-refundable education credits, self-employment tax, additional Medicare tax and net investment income tax for high-income earners, and additional tax, often called tax penalties, for non-qualified distributions from retirement accounts and HSAs. You can check out Schedule 3, Part 1 to review the complete list of non-refundable tax credits that reduce taxes paid dollar for dollar. Although there's a ton of information here, thankfully the IRS website includes simple breakdowns of each tax and credit, with instructions and publications that can actually be surprisingly easy to read. Once those non-refundable credits are subtracted and the taxes are added, we're almost to the end. Lines 25 and 26 show the tax payments you made throughout the year, whether as withholding from your income, estimated tax payments, or refunds you chose to carry over from the previous year. Lines 27 through 32 subtract a handful of refundable tax credits, meaning they can actually reduce your tax liability below zero to provide a refund. And this last line, 33, in the payments section, combines your total tax payments. Now that you see your federal income tax liability and can subtract out your payments you've made throughout the year, lines 34 and 37 show whether you have underpaid or overpaid your taxes, plus any estimated tax penalties that apply. If you find yourself receiving significant refunds or owing taxes in excess of a couple $1,000s, you may want to change your various tax withholding elections or plan to make estimated tax payments throughout the year. It's usually not a good idea to tip the IRS throughout the year interest-free. To complete the tax return, each taxpayer signs the return along with the tax preparer if you hire professional help. Keep in mind that most tax preparers look backward, while tax planners look ahead. You may benefit from annual or ongoing tax planning to ensure that 1, your tax reporting is accurate, and 2, you're not missing the forest for the trees in terms of dismissing your long-term tax planning opportunities. This video lesson covers a ton of material. If you feel as though you just drank out of a fire hose, you're not alone. Understanding the income tax formula requires multiple reps, and you'll become more confident as you review more of these documents. And to simplify and close out, here's a scaled-down version of the Form 1040 to reference moving forward. All income sources, minus exclusions from income, such as through your employer, equals total income. You subtract out the adjustments to income on Schedule 1, Part 2. That equals adjusted gross income, AGI. You subtract out the standard or itemized deductions. Subtract QBI deduction if that's applicable. That equals the taxable income. Then you apply the applicable tax rates to ordinary income and qualified income. That equals tentative tax. You subtract out the non-refundable tax credits, add other taxes, and now you have your total tax. You subtract out your total payments made throughout the year. Lastly, subtract refundable tax credits, and that gives you your tax refund or taxes owed.